If you own the right assets that paid you money every time you slept, how much faster could you walk away from your 9 to 5? Here's the little secret. Rich people are not working hard, that way they can spend all their money on a fancy car, a big house, and a nice vacation. This is what the majority of people are doing, and this is why the majority of Americans are bougie broke, which apparently, yes, is the term. You're making money, you're working hard to get that money, and then you spend all that money. You look rich, but you're actually poor. Rich people and people who become rich are doing something a little bit different. You're still working hard to get that money, but then instead of spending all that money, the people that become rich take that money and they invest it into the right assets. Then once you have those assets, you take these money from those assets and then you spend it. But this is difficult because it requires you to have delayed gratification. You're not taking your money and spending it. You're taking your money, buying the assets, letting those assets slowly grow and compound and make you some money. That way now you can go out and buy the things that you want without having to worry about the money. But this is how you actually become rich. Now watch what happens next. Let's assume in this situation you want to go and travel the world so money stops coming in. Well, you own the assets that keep paying you so you can keep funding the lifestyle. In this situation, if the money stops coming in because you're traveling or because you lose your job or because you get fired, well now the money stops coming in, but you still have the expenses to pay out. This is why so many people get hurt. And that's why in this video, I'm going to show you the 5 types of ETFs that you can consider investing in with specific examples. That way you can accelerate your wealth even faster. The stock market is a place for you to buy a piece of some of the biggest companies in the world. So instead of you going onto Amazon and then buying a pair of Nike shoes, where now you are giving your money to Nike, to Amazon, instead, you can go onto the stock market and buy one share, meaning one piece of ownership in Amazon, or one share, one piece of ownership in Nike. That way, when everybody else goes out and they buy that pair of shoes from Amazon, now you're the one that's getting paid because you own a piece of those companies. Now, all of this probably sounds good. Be the owner, don't just be the consumer, but here's where things get a little tricky. Let's say Amazon is trading for around $200 a share, meaning if you invest $200 in Amazon, you get one piece of ownership, one piece in the Amazon stock. Is that a good price or a bad price? Is Amazon a good stock to invest in or a bad one? Is Amazon innovating or not innovating? Is Amazon stock going to grow fast, or is their stock going to grow small? Or is their stock price going to fall? These are questions now that you have to be a little bit more sophisticated to be able to answer. And if you invest in the right company, well, now you can turn this $200 investment into $2,000 or even $200,000. But if you make a bad investment, well, now that $200 investment goes to zero. This is your stock research, and what I've learned is that most people are buying random stocks that they hear about on CNBC and Reddit and have no idea why they're actually investing in that stock. But that stock research is how you can have a better shot, not a guaranteed chance, but a better shot at actually finding a good investment. And just so you know, I'm building a tool to help investors with researching those stocks with the click of a button. That's coming in 2026. But the whole idea behind this video is to understand you don't have to find Amazon. You don't have to find Nike, because the reality is most people are not interested in actually doing that research, and this is where investing in an ETF can be very valuable. What is an ETF? Well, an ETF is a basket of stocks. So now instead of just investing in the Amazon stock or the Nike stock, you can invest into a group of 100 different companies. So maybe you have Amazon, you have Nike, you have McDonald's, you have Apple, you have all these stocks, maybe hundreds of stocks, if not thousands of stocks lumped into this one fund. And now if you buy one share of this fund, you're buying a basket of all these companies. Now watch what happens next. Let's assume that Nike starts producing some really bad shoes, and now they're on the verge of going bankrupt. Well, if you invested all of your money into the Nike stock, well, now you would have lost everything. But here, if you invest in this fund and Nike goes bankrupt or is on the verge of bankruptcy, this fund will kick Nike out and they'll replace Nike with somebody else, maybe Adidas, and it's completely passive on your part. That's what an ETF is. It's a fund that's giving you exposure to a lot of stocks, as opposed to you having to go out and find all those stocks to invest in, and you don't have to worry about managing the ETF. My goal for you in this video is to know what some of the different options are out there. That way you can find investments that can grow your wealth even faster, but you have to understand what the meaning of grow your wealth faster is. So let me show you. If you can invest $1,000 a month and you do this for 30 years, the amount of wealth you build is going to depend on how fast you can grow your money. So let's go over a few options. If your money grows by an average of 7% a year, your $1,000 a month is going to grow to around $1.13 million. But if you can do a little bit better, where now you're getting about 10% returns a year, and again, I'll show you different ways that you can do this, well, now your wealth is going to grow to around $1.9 million. And if you can get around a 13% return a year, a little bit better, well, now you can see your wealth grow to around $3.5 million. So if you can get a little bit better returns, we're not talking about 200% returns. If you can do a little bit better returns, you can add up to hundreds of thousands, if not millions of dollars of more wealth over the course of your investing career. So let's go over different ways that you can invest your money, some that are more risky with higher potential returns, some that are less risky with lower potential returns. That way you can build a portfolio that makes more sense for you. Now I gotta give you the disclaimer, which is of course investing is risky. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. I'm not telling you what to invest in, I'm just giving you examples to help you start thinking like an investor. There are 5 categories of ETFs that I want to talk about. Number 1 are niche ETFs. Number 2 are income producing ETFs. Number 3 are market ETFs, just to get the returns of the market. Number 4 are growth ETFs. And number 5 are international ETFs. So let me start by talking about niche ETFs. More specifically, I want to talk about AI, I want to talk about healthcare, and I want to talk about defense. AI has been all over the news in the world, and the reality is money is pouring into the AI industry. Now, there's a very good chance that we're building an AI bubble. We don't know if and when it's going to burst, but there's a very good chance that there's an AI bubble bursting. That being said, AI is not going away. AI is going to change our economy, AI is going to change our technology, and AI is going to change our job market, period. That can create an investment opportunity. Now, for some of you, you're going to want to go out and find companies to invest in that are benefiting from this investment into AI. For others of you, maybe you don't want to do that. Maybe you just want to find a fund that can give you exposure to AI. Again, it's risky because there's a chance, well, the technology can completely shift. But if that's something that you believe in, well, now you can start looking at different ways to invest into AI, assuming that you understand that it's volatile, meaning it's going to go up and down. And if the AI bubble bursts, you can expect these funds to get hit extremely hard. How do I know? When the dot-com bubble burst, we saw dot-com companies fall by over 75%. The NASDAQ fell by 78% when the dot-com bubble burst. So you have to understand the risks, but let's talk about different ways to get exposure to AI. Option 1 is an ETF called BOTZ BOTS. This is an ETF, meaning fund, created by a company called Global X that gives you exposure to robotics and artificial intelligence companies. Now, this fund is relatively new. It was created back around 2016, and it has averaged around 9.8% a year over the last almost 10 years since it was created. Example number 2 is an ETF called CHAT. C-H-A-T. This ETF is created by Roundhill Investments, and it gives you exposure to generative AI and technology companies. This ETF is even newer. It started back in 2023, and it has averaged about 25% in growth a year. But again, it's so new, which is why it's more risky, and also started during a time where AI has been exploding. I mean, over the last few years, you've seen a lot of money pour into AI, so you have to understand the risks associated with that. But maybe you say, this technology stuff is a little bit too volatile. I want to invest in something more proven, like healthcare. Well, if you believe that more money is going to flow into healthcare, you can look into certain healthcare ETFs, and let me give you a couple examples. Example number 1 is XLV. This is an ETF created by a company called State Street, and is giving you broad exposure to the healthcare industry. Over the last decade, this ETF has averaged about 8.7% of growth a year. Another example would be VHT. This is created by a company called Vanguard, and this is also giving you exposure to the healthcare index, and over the last decade, this has grown by around 8.4% a year. Again, to be clear, when I say average, this doesn't mean that the fund has grown by 8.4% every single year. It means it has averaged that despite the market crashes, despite the recessions. This is what the average has been. And of course, just so we're clear, past returns do not guarantee any sort of future returns. And then we have defense. And as crazy as this is going to sound, the reality is when there is more talks about war, when there is more concerns about war, there is more investment into war-related companies, defense companies. And that could create also an investment opportunity because the companies that are producing armor, tanks, jets, ammo, these are private companies. And so if those companies are getting bigger contracts from governments, not just in the United States, but from around the world, well, that can create bigger profit opportunity and potential investment opportunity if that's something that you are interested in. Let me give you a couple examples. Example number one is an ETF called ITA. This is created by a company called iShares, who is owned by BlackRock, and this is giving exposure to United States aerospace and defense companies. And over the last 10 years, this ETF has averaged around 14.5% a year. Example number two would be an ETF called PPA. This is created by a fund called Invesco. Again, this is giving exposure to aerospace and defense companies. And over the last decade, this fund has grown by around 16.9% a year. So why am I telling you these numbers? Because if you remember just a minute ago, I showed you the different types of wealth that you could have after 30 years, depending on how fast you can grow your money. And I just want you to understand the different types of returns we have seen in the past from different types of industries. Now let's talk about number two, income. And this is where I also want to remind you that for those of you that are investors or want to become investors, I did put together a brand new free investing masterclass where I'll walk you through how you can find hidden investment opportunities before everybody else. And I'll show you the exact system that my firm and I use to research investments, to find opportunities before they hit the headlines like CNBC and Reddit. It's a completely free masterclass. So if you want to learn more about how you can be a better investor and research investments, there's a ton of value in there. And all you have to do is register. When you register for the masterclass, you're also going to get access to Market Briefs, which is my newsletter for investors, for free, all complimentary. So if you want to get the investing masterclass and Market Briefs, all you have to do is register, and I have that link for you down in the description below. Now, when I talk about investing for income, I mean actually producing an income, because if you buy a stock for $100 and it goes up to $200, you don't actually make any money until you sell. And then when you sell, well, now you have to pay taxes and you no longer own that asset. When you invest for income, now you buy a stock for $100, maybe it goes up to $200, but it's paying you regular income called dividends along the way, generally every 3 months, meaning every quarter. And so when we talk about investing for income, that's what we're talking about. We're talking about producing regular income, regular dividends from the investments that you're making. And the reason why some of these companies pay these dividends is because certain companies, like McDonald's, have billions of dollars of profit at the end of the year. And there's three things they can do with that profit. They can save that money for an emergency, they can take that money and invest it back into the company and open new stores and create better burgers, or number three is they can just give that money away to their investors, people like you and me, in the form of these dividends. So when we talk about income investing, we're talking about investing for those dividends, but you have to be smart, so let me go over a few examples. Example number one is VYM. This is an ETF created by Vanguard that's giving exposure to high dividend paying companies in the United States. And at the time of recording this video, VYM is paying out around a 2.5% annual dividend. So if you invest $100, you're going to get $2.50 in income a year just from dividends. Example number two is SCHD. As a disclaimer, I'm personally invested in SCHD and VYM. And SCHD, at the time of recording this video, is paying around 3.6% a year in dividends. Now you might say, well, that must be better than this one. Hold your thought. I want to show you how you can calculate this a little bit better. By the way, SCHD is created by a company called Schwab, and this is also giving exposure to United States companies that are paying out these high dividends. And then we have example number three, MORT, M-O-R-T, which is currently paying out around 12% a year in dividends. Yes, 12% a year. Now, what does MORT do? This is called a REIT, a real estate investment trust. So this is a fund that's giving you exposure to companies that are involved in the business of mortgages and buying and selling mortgages. So more risky, which is why you're getting these higher potential returns. And now you might say, okay, Jaspreet, if my goal is to be an income investor, obviously this is the best case because I'm getting the most income, right? Wrong. When you are investing your money, you need to understand the underlying asset, the underlying investments that you're investing in. A lot of people, the mistake that they make is they get caught up on these numbers and they don't actually understand what it is that they're investing in, and it can end up costing them a lot of money. So not only do you want to look at what is the dividend today, you want to look at, well, is the dividend going to continue to grow, and what's going to happen to the value of the underlying asset. So let's take a look at what has happened with these three funds, and I'll give you some calculations that you can do. That we can get a better understanding of what your income projections could look like. Let's start at the top. VYM over the last decade has grown, this fund has grown by around 11% a year. That's the actual ETF price, the stock price. And the dividend has grown by around 5.9% a year, every single year over the last 10 years. So you're seeing dividend growth and appreciation in stock price over the last decade. The SCHD ETF has grown by around 12% a year. Again, that's the stock price. The ETF price has grown by around 12% a year for the last decade, and their dividends have grown by around 10% a year every year for the last 10 years. MORT, the mortgage REIT, has grown by around 3% a year over the last decade. while their dividends have fallen by around 3.5% a year every year for the last decade. This is why your investment analysis has to go way beyond just how much the dividend is. You want to understand the underlying asset, because if your asset is growing while the dividends are also growing, that gives you the opportunity to really compound your wealth, because every time you invest more money, not only are you making more income because you're buying more shares, but because your fund is also producing more income for every share that you own. So for example, you're investing $1,000 a month. You do this for 30 years, and you invest your money into an income fund that's paying you a 3% annual dividend. Now, what we've seen is that the 3% annual dividend is expected to grow by 5% a year, so 5% growth in the dividend that you're getting, and this fund is growing by 10% a year. What is your wealth going to grow like? Well, now what's going to happen is if you're reinvesting those dividends, you're going to end up with around $3 million at the end, plus about $30,000 a year in income, not to mention the hundreds of thousands of dollars that you've already gotten from dividends. If, on the other hand, you invest the same $1,000 a month for 30 years into a fund that's paying you 10% a year in dividends, but these dividends are falling by 3% a year, and this fund only grew by 3% a year, well, now instead of having $3 million, you're going to have $700,000 at the end of those 3 decades. And now you're going to be making about $9,000 a year in dividends. So yes, you're getting more dividends today, but if you don't look at the underlying value of the assets, you're really reducing the value of your total investments, and you're also going to reduce how much money you're going to make in income. That's why it's so important to understand what it is that you're investing in. This brings us to number 3, investing your money into the markets. You may have heard the markets have grown by 10 to 11% a year over the last number of decades, over the last 100 years. How do you actually just expose yourself to the stock market? Let me show you. If you just wanted to invest your money into the broad United States stock market, there is a fund out there called VTI. This is created by Vanguard, and this is going to give you exposure to the total stock market. So the 2,000 some stocks that are trading in the stock market, if you buy 1 share of VTI, you're getting exposure to all 2,000 of those stocks. And since 2001, VTI has averaged around 9% growth a year per year over those 24 or so years. Option number 2, if you want to get a little bit more niche, is to invest your money into the S&P 500. So for example, SPY, this is created by a company called Spider, SPDR is pronounced Spider, and this is giving you exposure to the S&P 500. That is the 500 largest companies in the stock market. So instead of investing in all 2,000 some companies here, you're investing in the biggest 500 companies here. And what we've seen is that over the last number of decades, this has grown by around 10.5% a year. But if you wanted to get a little bit more niche into the NASDAQ is the group of the 100 largest companies in the stock market that are not financial. So these are primarily tech companies. This is now much more volatile, but has more potential upside. QQQ is an ETF that will give you exposure to the NASDAQ. And what we've seen is that because it's so tech heavy, well, it has grown a lot over the last decade because so much money has flown into tech. Over the last decade, this has grown by around 20% a year on average. Yeah, I know that's crazy, right? Well, over the last number of decades, this has grown by around 14% a year. But this is more volatile. When you see crashes or recessions, QQQ goes down even further than SPY. So you have to understand the risk and reward ratio here, because yes, a lot of potential here. As more money flows into tech, this is probably going to benefit more. But when the tech crashes happen, this is going to hurt even more. But these are funds that can give you exposure to the broad market. So now we talked about how you can grow your money with the market. Let's talk about how you can grow your money a little bit more aggressively with growth funds. Growth funds are giving you exposure to those companies, the stocks that are more aggressively working to grow. More risk for more potential return. But the whole idea here is as these smaller companies are working to grow quickly, it can create more potential upside for the investors that are willing to take on that additional risk. And here are a couple ETFs that, again, you can consider. I'm not telling you what to invest in, but you can consider. Option number 1 is an ETF called ILCG. This is a fund created by iShares, again, owned by BlackRock, that is giving you exposure to those growth companies. Over the last 10 years, we've seen a lot of growth with these growth companies, and this fund has grown by around 16% a year over the last decade. So again, you can do your calculations on what these types of returns could mean for your portfolio. But again, Past performance does not indicate future performance. Option number 2 is an ETF called VUG. This is created by Vanguard, again, another institution that is giving exposure to growth stocks. This is their growth index fund. And over the last 10 years, we have seen VUG grow by around 17% a year on average over the last decade, where again, we've seen a lot of traction in these growth stocks over the last 10 years. And last but not least are international stocks. So if you believe that there's going to be more diversification over the next 10, 20, 30 years, and there's going to be more opportunity outside of the United States, well, then you can also consider diversifying by adding in some international, non-United States stocks or funds into your portfolio, and I'll give you a couple examples. Example number 1 is VEA, which is giving you more exposure to developed countries. This is created by Vanguard, and this is giving you exposure to the developed market fund like Japan, the United Kingdom, and Canada. Over the last decade, we have seen this fund, VEA, grow by around 7.8% a year over the last 10 years on average. Example number 2 would be you investing your money into emerging markets. These are the smaller countries, and a fund like IEMG, which is created by iShares, again owned by BlackRock. This will give you exposure to their emerging market fund, which means you're investing in companies like China and Taiwan and India. Over the last 10 years, this fund has grown by around 7.1% a year. So if you believe there's going to be more opportunity internationally, again, there are funds that can give you exposure to that. So now we talked about the power of investing your money in the stock market. We talked about what an ETF is, and we talked about different ways to get exposure to different types of funds. We talked about investing in niche funds like AI funds and healthcare funds and defense funds. We talked about how you can create income from your funds. We talked about how you can invest in the broad market. We talked about how you can invest for growth. And now we talked about how you can invest internationally. The last thing that I want to say, if you want to succeed as a passive investor, is that the strategy to win is a simple strategy, but a very important one that I call ABB. Always be buying. And what that means is the strategy to win when you are a passive investor investing in these types of funds is every week or every 2 weeks or every month, you have an automatic cadence. Your money is going to get pulled out of your checking account and automatically invested into a portfolio of funds, and then you do not touch it. You let this happen. Always means whether markets are going up or down, you keep doing it. If it's raining or sunny, you keep doing it. If it's a Democrat or Republican in the White House, you keep doing it. The mistake that so many people make is that when markets crash, they stop buying good investments. But when markets are crashing, that's when good investments are selling at a discounted price. That's why the key is to follow this always be buying when markets are up and down, because those downturns create some of the best buying opportunities because most people are running away and good investments are selling at a discounted price. So you got to make sure it's a good investment, but if you're willing to do that for the long term, years, decades, that's where the wealth opportunity is. So I hope you got a lot of value out of this video. Again, if you want to watch my investing masterclass, I have that link for you down in the description. And if you enjoyed this video, the best thank you is a referral. So please share this video with a friend, a colleague, a family member, or a fellow investor. Thank you. The United States government owes more than $37 trillion. That means your tax dollars are being used to pay interest on all that debt. And this is where President Trump has been proposing a new plan to help pay off this debt involving gold and involving crypto. And most people have no idea of how this plan works or the implication of this new plan on your money.